Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. Eastern, as we typically do on a Wednesday. Today is November 12th, 2025. We just had a lovely Veterans Day. I had a couple days off. I was doing stuff with my granddaughter and my son, and all sorts of fun. A lot of animals, zoos, aquariums, La Brea tar pits, you name it. We did it. But now back in the swing of things with the market, and to help me kind of dissect and catch up to what was going on while I was on vacation, we got Joe Fahmy from Zor Capital. Zor Capital. He's a portfolio manager over there, and we typically talk about Joe being follow through day Fahmy, but right now it doesn't seem like we need a follow through day. We've just been in a very nice, steady uptrend. So, Joe, welcome to the show.
Thanks for having me on again. I appreciate it and look forward to our conversation.
Absolutely, and I again just can't believe you wore a tie. What kind of operation do you think we're running over here? Uh, I should also mention that in addition to Zor Capital, gosh, Joe, you put out a lot of great educational content, so I want to make sure people know about that. JoeFahmy.com. You're a great follow on X at JFahmy. Yeah, you do a really good job, and I think sometimes I appreciate what you send out there in terms of just putting things in perspective. So maybe what we can start out with is kind of this big picture view of where we're at, because we just had, well, personally, I did not have a great October. And there was a lot of kind of chop, a little bit of a pullback. And while I still believe in the overall bull market, there's always this push and pull of, I don't want my drawdown to get too big. I know that things could get worse before they get better, but then, I don't want to lose my positions, but I don't want to, again, have a bigger drawdown. How do you kind of handle that push and pull when you get into kind of a typical sideways market or pullback, what have you?
Yeah, I think that's the challenge of managing a portfolio of stocks, or if you have a blend of ETFs and so forth. But if you're trading growth stocks, it's always that challenge of trying to stick with your positions, but also trying to keep the drawdowns in check and minimize the volatility. Um, One of the most simple ways to do it is just use a smaller position
Hmm.
with a larger time frame, because if you buy 100 shares of a stock and take it for 3 points, or you buy 50 shares and take it for 6 points, it's the same $300. The
Hmm.
only difference is with the 50 shares, you can relax a little bit. You can give it a little bit more room. You can chill out, so to speak, so that you're not always micromanaging your position. So that's just one way. I know that doesn't work for people because they want to make as much money as
Yeah,
possible, as
right.
quickly as
And I want it
possible.
now.
Exactly. I know. I always joke we live in the most impatient world ever. But if people have a problem with the volatility, or they have a challenge with maintaining some of their positions, or saying, I'm getting stopped out too much, I'm getting chopped around, reduce your position size and give it more room. The
Hmm.
7% O'Neill rule is a great guideline, but that depends on your time frame. I have a friend who day trades, his stop is at about 1%. I
Yeah.
have another friend who is longer term, his stop is 20 to 40%. So the 7% is a good guideline if you're buying properly off of a cup with handle, as far as, again, if you're buying properly, but you can bend the rules depending on your time frame.
Yeah, it does give you a certain amount of flexibility, if you will. So, correct me if I'm wrong, but you're kind of more of a 5% position size kind of guy, right?
Roughly, yeah. Yeah.
Yeah, roughly, yeah. So, now I guess one other component. So the the downside that a lot of people feel like is, oh, with smaller positions, as you said, I'm not going to be able to make that killing when I am right on a stock. But I guess the other part too is, whereas having 20 stocks is, a lot more diversified than having eight, let's say, it seems like with the market nowadays, the correlations can be so high. Sometimes you aren't getting the diversification that you maybe think you are, because everything's just so correlated. Do you ever find that? Because it's like, oh, I have all these positions, but when the market gets hit, everything's so correlated. it just ends up making it more complicated. And I have all of these stops and I have all of these things to manage now.
Yeah, a couple of things really quick. So the 5% position, I always say it's a big difference managing money for clients and for other people versus trading for yourself.
Absolutely.
So the reason 5%, if it's a larger mega cap name, I don't mind going 7, 8, 9%. If it's a biotech, I'll go less than that, 1 or 2%. But let's just use 5% as round numbers. The reason is that if God forbid a stock gaps down 20% on a 5% position, it's only going to hit the portfolio 1%.
Yeah.
So round numbers on a $100,000 portfolio, it's going to hit $1,000. It's not fun, but that's manageable. It's not going to blow you up. If you are an individual and you have no one to answer to, except maybe your spouse, but if you have nobody to answer to, and you want to put, let's just use round numbers, $100,000 portfolio and 3, 4, 5 stocks, you can go right ahead, but you're going to have much bigger volatility. So that's where you have to differentiate whether you're managing for others or managing for yourself. Even if you're managing for yourself, as most people are, you still want to try to contain that volatility. And again, it's that there's no right or wrong answer of that balance between position size and all that. As far as the correlation, there's periods where you're right. I've seen all three scenarios where you'll see a buy program and your stocks won't move, or you'll see a sell program and your stocks are not correlated. But you're right. The third scenario is most of the time, most of the stocks are going to move with the overall markets. Right. And one way to mitigate that is maybe having a balance of individual stocks and some ETFs so that can also help offset a little bit of the volatility. Maybe own some of the index because there's always sector rotation. And I'm not a fan of chasing the sector rotation. So recently, while some of tech is pulling back, they're rotating into some of the financials and healthcare are moving. And rather than chasing it around, I'd say, okay, own the index or own some sector ETFs. There's 11 sectors in the S&P, and there's a bunch of different ETFs for all of them. You can own some of those to participate, or if you want to be less correlated, it depends on what your strategy is.
Well, and let's talk a little bit about, of course, with the sector ETFs, sometimes you end up getting pretty concentrated in just a couple names when you buy one of those ETFs. XLC or XLY, for instance. XLY is 40% Amazon and Tesla. So those two stocks account for 40%. XLC, Meta, and Alphabet. XLK, it goes on and down. XLE even. It's ExxonMobil and Chevron, right? Exactly. So sometimes it's, you feel like you're getting, I'm getting this, more diversified, more names because I've got an ETF. But again, you're really kind of beholden to the market cap weighting, and sometimes you're not quite as diversified as you think, I guess.
Yeah, there are some equal weight ones as well. And I also look at it as, let's say, take SMH, for example. If you say, okay, there's a chip boom and NVIDIA is benefiting and Broadcom is benefiting and Taiwan Semi, yes, those three make up 40% to your point of SMH, but it's also a way to not deal with single stock risk and to give you broad exposure. If you say, well, which one should I buy? Do I buy all three? But I also see some of the chip equipment names are doing well and some of the memory chip names are doing well. This just gives you broad exposure to all of them. And you're absolutely right. Because of market cap, a lot of them are going to be 20 to 40% will only be in the top 2 or 3 names. But that's why you can just look up the components and see what works for your temperament, so to speak.
Yeah, no, absolutely. So you've started off just right off the bat here with a number of ways in which to kind of reduce that volatility. Position size, ETFs. I mean, certainly that is a way to reduce volatility as well, because again, you get things with a lower average true range typically when you're doing the ETF size. And anything else that you wanted to share in terms of the volatility side of things?
Yeah, another reminder is I'm a big fan, and I know this sounds like a really, it's a funny comment. You're either selling into strength or you're selling into weakness.
Right.
When you're selling a stock, you're either taking profits or you're getting stopped out. So it's either on the way up or the way down. I prefer in a good market to take some profits into strength because at the time it's the high And as their things are running, and keep in mind, if you have 100 shares, it's not an all or nothing decision. You can sell 10, 25, 50 shares. People feel when they buy or sell a stock, it has to be all or none. You can piece in and out.
Hmm.
But another way to mitigate some of that volatility is recently, in the past few months, there have been some speculative names that have gone up 30, 50, 100% or more. And then when they run, let's say 100%, and they come down 20 to 50%, some people are saying, what the heck is going on here? Keep in mind, a stock might have just gone from 50 to 100 and pulled back to 70.
Hmm.
And you say to yourself, well, that seems like an extreme decline. Well, it was also an abnormal move in a short period
Right.
of time. So, one way to mitigate those extreme declines is, what if when the stock goes from 50 to 100 on the way up, you sell a little bit into strength? So that way, when it comes down, you don't have as big of a position, because let's say a 5% position, you don't take any off the table, becomes 10. And then when it
Hmm.
drops, it seems to hit your portfolio. So, reminding people to take some profits into strength. Most people don't want to because they have FOMO,
Yeah.
fear of missing out. And my whole point is, what did you just miss out on if you had a 50 to 100% gain in a short period of time? And I know they're saying, well, I might miss out if it becomes a 5x or 10x. Well, just a reminder that, taking some profits along the way, in addition to, as I said, smaller positions, expanding your time frame, and a blend of ETFs, all of those are ways to mitigate and minimize some of the volatility.
Hmm. It's also worth mentioning that, just to reiterate what you said, Joe, is that it doesn't have to be the all or nothing, right? You can just let the market kind of decide, okay, if you take a little bit off and it is going up even more, it's not like it's going up without you, because you still have, shares that you kept.
Right.
Um,
And one other thing, though, is also going back to time frame. If you
mhm,
are playing, if let's say you've done your due diligence and you're playing a bigger move in a stock, it's a simple concept of, you're just going to have to deal with volatility. I'll give you
mhm,
a quick example. Carl Icahn many years ago took a 10% position in Netflix, and he made $2 billion off of it. And you
mhm,
can go back and plot it on the chart. He held it for 2 to 3 years, but he held through five, six, or seven, 20 to 35% declines. So my
mhm.
point is, if you're playing a bigger move and you have a strong entry point and you have a cushion, some people have a longer term time frame, you're just going to have to deal with the volatility of normal corrections if you're holding for 2, 3 years or longer.
Yeah, no, it's a very good point. Now, if you do some of that selling into strength, as you said, one of the biggest benefits is that almost by its nature reduces your drawdowns to a degree. Because you're kind of selling things when they're at highs, and it naturally gives you less exposure when a pullback happens. Do you just sit on that cash, or do you redeploy it? I know you just said that you don't want to necessarily chase rotations, but what do you do with that cash if it starts piling up because you've been selling into strength?
That's a great question. And I hate the cop out answer of it depends, but it
Right.
really just
Hey,
depends.
that's
If
the
a
answer a
whole
lot of
bunch of
times.
stocks I mean, I'm screening every night,
Hmm.
looking for bases, looking for safe entry points and pullback buys and so forth. If everything is extended, then I'll just sit on that cash and wait patiently for some sort of a pullback. If I sell some into strength and I see another setup, I can always take a smaller position in the new setup. So it really just depends on what's going on with the market. And overall, has the market just gone on like we just saw recently, a 2, 3 week run where it got a little bit extended? I might want to sit on that cash. And it's not like I'm sitting in cash, because some people will say, well, my money has to be working for me. It's not like I'm sitting in cash for 7 years. Like,
Right.
we're talking about a few weeks of waiting for a pullback or waiting for things to set up. But by selling some, if things keep going and you don't see a pullback, you still participate because you still have some.
No, absolutely. And yeah, I think that's a key reminder, because when we say go to cash, it's kind of putting the chips in when things are right, and kind of pulling them back when things aren't. But a lot of times that is very short term. There might be 3 or 4 times during the year where you're scaling back a little bit, and then you push your chips in. But it's a reminder that when we say, "Oh, the market had a great year this year," it it's not linear, right? There's a lot of moves up and down along the way. Sometimes all of the move is in the first part of the year. I think, what was it, 2012? I feel like that's when I made all my money in the first quarter, and the rest of the year was just trying not to lose it.
Oh,
You know,
there have been some years where if I went 100% cash in March, I would have been great taking 9 months off.
yeah,
There's been other
right.
years where I've been negative, and then the fourth quarter saves you with a huge
Yeah,
fourth quarter rally. So that's where the
I would say
challenge.
2007. 2007 was a great example of that.
Yeah,
I was getting chopped around all, you had the Shanghai surprise in February and all of this different stuff. And it wasn't until September and October that, oh, now it's a good year. But November, again, things started coming in pretty hard. So if you were a little slow on that, yeah,
yeah.
you
And to your
suffered.
point, we had pretty much a 20% correction earlier this year in just 2 months during the
Hmm.
tariff scare. So
Hmm.
it's not always going to be smooth sailing. That's the market's not designed to be easy.
Right. Well, let's talk a little bit more about the market because yeah, I mean that's what we like to do here. And you made the point of course this is not something during the tariff tantrums that you would have necessarily wanted to sit in. In fact, if you were able to raise cash during that, you actually were able to get in at the follow through day around April 22nd and really have kind of a best of both worlds where you didn't take the drawdown, but you participated in the bounce. But now, I guess there's kind of a couple different ways to look at the current market. A lot of people think of, well, gosh, we've come off we've come so far from those lows, but then other people are looking at this and saying, well, in some ways, aren't we kind of just breaking out of this base here, and this could be the beginning of something even better. So what's kind of your take on that big picture?
Yeah, I mean, my big take is, we started a new bull market in May of 2023. Some people say it's the October of 22 lows. It's all semantics. Who really cares? Yes, we made a low October of 22, but I'm saying May of 23 because this bull market is being led by AI, and that's when Nvidia had the greatest quarter or surprise in the history of the market. So that's when the true market leader really started to kick things off with the demand in AI. So I think this could be very similar to the 90s, where I've been saying, let's say 23 to 2023, it could be a 4 to 5 year bull market. So I think we still have a couple of years left in this. Even Jensen Huang has talked about we're only a couple of 100 billion spend into a multi-trillion-dollar spend in AI. But this is the big factor in all this is it's never going to be smooth. It's not going to be straight up. If you told me take any 5 year period, or you had a time machine and went forward in time and said this 5 year period was going to be a bull market, I can guarantee there's going to be major corrections and shakeouts and
Hmm.
pullbacks along the way. Just like from 95 to 99, you had a major correction in 97 with the Japanese debt crisis, and then in 98 with long-term capital and the Russian debt crisis. There were major corrections along the way. So if we were 23, and let's say this goes into 2027, we had that tariff tantrum, as you mentioned. We're going to have, it's not going to be smooth. So bigger picture, I still think we're in a bull market, but there's going to be shakeouts and pullbacks and rotations and corrections along the way. It's just the nature of the markets.
Hmm. Absolutely. Now, of course, the one, the 99 2000 was known for that bubble. And look, a lot of people were calling for the bubble really, really early. I mean, if you were, God forbid, shorting when you thought the bubble started, you could have gotten yourself in some real big trouble. But even if you just said, "Oh, I think we're in a bubble, I'm not going to participate," you could have missed out on one of the greatest bull moves in history.
Yeah.
So I guess, when do you know? When do you know that it's time to take some of that off, or do you just? I mean, you said at the beginning, you either sell into strength or you sell into weakness. Um, what are you kind of using as your game plan here?
I look medium term. I'm glad you have the weekly chart up. The red line's a 10-week moving average. That's an area of institutional support. I've said this over and over. The big institutions control the markets. My opinion doesn't matter. Your opinion, as much as I respect, with all due respect, doesn't. No one's opinion matters because the big pension funds and mutual funds and hedge funds, they control the market. So we have to do our best to interpret what they're doing. And if a simple 10-week moving average is traditionally an area of institutional support, if we're holding that level, that tells me the institutions have our back and to continue sticking with the trend. When we see a lot of distribution days and a lot of leaders break down and we start to break through that 10-week, then that would be a sign of at least a yellow light to get cautious and maybe raise some cash and get more defensive. Some people have a different time frame where they use the 200-day or the 40-week, the black line on that chart. Mm-hmm. This is what I mean by reducing position size and giving yourself a little bit more time, especially if you are working full time. Maybe you're in a different time zone. You're in Europe, you're in the Middle East, you're in Australia. You love trading the US markets. You're retired or semi-retired. You don't want to watch the markets all day. There's nothing wrong with expanding your time frame if you're okay with that and using that sort of, I know a lot of longer term trend followers use the 200 days. So those are the, just to keep it simple, areas to know whether the institutions are continuing to back this market or not.
Mm-hmm. One of the things that's been a little bit tricky, though, as strong as the Nasdaq looks, and I'm going to put the S&P 500 up because it's, same thing. It's holding the 10-week moving average line. It's just trending so nicely above the 10-week moving average line. One of the issues for some people pointing out is that breadth. RSP. This is the equal weighted S&P 500. So it's kind of like, oh, what are the other 493 stocks doing besides the Magnificent Seven? And this has been a downtrend. Now a little bit more recently, it seemed like it started perking up, but it's this was spending time below its 50-day moving average line. This was just not having quite the oomph. And again, if you look at your average stock, a lot of them were below the 50-day moving average lines, even on the S&P 500. So what do you make of that?
Yeah, I even just tweeted out, as of today, about 35% of the S&P 500 is 20% or greater off of their highs. So a lot of, I hate to use individual stocks in the bear market phrase, but a lot of individual stocks have corrected considerably. And to your point, with the equal weight, I mean, this is where it just depends on portfolio construction. Some people say it's the same 10 stocks going up and the rest of the market stinks. And my wise ass response to that is we'll just be in the 10 stocks that are going up. But that doesn't work for everybody. But this is where it just depends on time frame and portfolio construction. I've said this so many times. A lot of growth stocks are even more than 20% off of their highs, but that's because they just made literally 50 to 100% type of gains recently.
Right.
So they're gonna, you have to take the good with the bad. You can't complain when something's 30% off of its highs when it just went up 100%. Mm-hmm. So it's a challenge. Of course, I would like to see the entire market participate, small caps, mid caps, all the sectors. It is a challenge right now. You'd like to see it all, but at the same time, the majority of earnings estimates that are going up are coming from the Mag 7, and they're coming from a lot of those leaders. And I would just say try to stick to as best as quality as you can. There's some friends of mine who are value, and they would never touch the Mag 7, so they have to find more beaten down names, but that's also if you have a longer time frame. So it really just depends on your strategy, your time frame. But my simple answer out of this whole rant or ramble is I just try to stick with as best of quality as I can, as long as they're holding key support.
Yeah. And since you brought up the small cap index, let's just take a quick look at the Russell 2000. Certainly one of the issues here, it got decimated as rates started rising. Fed was tightening, and that was especially detrimental to the Russell 2000 and small cap index. But the relative strength here, again, the Russell usually is historically an outperformer, but the relative strength has certainly been on the ropes. There were a lot of false starts, it felt like, where it seemed like it was going to start going. It was one great week, and then it was kind of back to, oh, I'm not sure. what's your take here on the small cap? I know a lot of people have been talking about second half of 2025. Here we go, Russell, and it's still, I guess, not conclusive.
Yeah, to your point, I mean, I just feel like a couple, whatever the statistics are, a few of the Mag 7 are larger market cap than the entire Russell 2000, whatever the stats
Right.
are. I don't want to say they don't matter, but to your point, they topped out at the end of 2021 when the Fed basically said they were going to raise rates. And we'd never seen 500 basis points in less than a year in the history of the market. So that's going to affect smaller companies that rely on lending
Hmm.
and rely on and interest rates can hurt their business. But with I think the price action is improving because the market is forecasting lower rates down the road, and it should hopefully help the broader market with small caps, with housing, biotech to keep the lights on while they're waiting for phase trials. They also rely on funding, so hopefully the lower rates will lift a lot of this. But yeah, it's sometimes you're right that the Russell used to be a very good sign of risk on and outperforming. And it just, I'm reminded of the Paul Tudor Jones line, you adapt, evolve, or die. And I'm paraphrasing, but the key word is adapt. I've
Hmm.
noticed it as well. And I just haven't really been getting too involved in a lot of small caps, just my way of adapting to moving towards what's growing right now.
Hmm. Well, and since you brought up the Fed, let's just again remind folks of what happened here. This is the 10-year Treasury yield, so not the Fed exactly, but 2022, of course, we saw this big move up in the 10-year Treasury yield as the Fed was tightening. Now we've started a loosening and rates coming down. December, I think there was a little bit of that kind of shock to the system because everyone was thinking December was a lock, and then it was like, oh, far from it. I think were the words that Powell used, and that spooked things on quite a bit. So what is your take? I mean, we are in a cutting cycle, it seems, but we also, I mean, it's not like it doesn't feel like the economy necessarily needs all this stimulus, like there's a recession going on. The labor market, there's a little bit of push and pull there in terms of whether or not there's been some problems. And I mean, I don't want to necessarily get too wrapped up in the weeds of macro. I know that back in 2022, I loved some of the stuff that you were doing in your, the spaces where the most important Fed meeting of all time or
Yeah.
whatever, because it felt like that's what, or not even the Fed meeting. It was like the most important CPI, and
I know. And now with the government starting back up, we're going to get like 15 reports in one day. My head's going to spin. I don't even know
right,
what
exactly.
I don't know what I'm going to do with all this lagging data.
Yes, exactly.
I mean, look, I'm with you on this. We could literally go down the rabbit hole of the macro. There's so many moving parts with jobs, with inflation, with just all the different manufacturing, all the different components of the economy. I try to keep it simple. If this is a problem, it'll show up in the tape. If it's not a problem, the institutions will continue to support it because they have more resources, more brains, more analysts, more everything to really try to forecast what's going on. And if it's a problem, it'll show up in the tape.
Yeah.
That's all.
Um, yeah, that's my go-to. I mean, even on the political side, oh, you think Trump is a genius and tariffs are awesome, great. Or you think they're the worst thing in the world, that's great too. I
It's
just don't
yeah,
care.
it's the Warren
I'm
Buffett
going to look
line.
at the
Don't
chart and figure it out from there. Because
I
if I
love
use,
the Warren Buffett quote: "If you mix your politics with your investing, you're making a great mistake." So
Mhm.
I've done great under both. Again, who cares about the politics? I've done great under Democratic, Republican presidents. We've had big corrections under both as well.
Mhm.
So I try to keep it simple. Stick with the companies. Stick with what the institutions are doing. It makes for fun, I guess, or intellectual. You sound intellectual with these types of
Right. Mhm.
conversations. I'd rather just stay dumb. It's easier.
Yeah. Well, and I think the benefit of staying dumb is you stay flexible, right? I feel like I'm easily swayed, um, and what sways me the most is the market. and what the chart does. If the chart
Yeah.
does this, then I'm like, oh, okay, well, hey, yeah, then yeah, these things are probably good. If the chart does something else, well, maybe they're not so great. So um, speaking of kind of again being swayed, one of the things, of course, that is you know this overhang, I guess, is the sentiment. I was reading one of your blog posts, and on the bubble sentiment, you were talking about this was like the a bubble of bubbles, because so many people were saying there's a bubble, that it was almost like a
Oh
bubble
yeah,
in
there's a
itself.
bubble in people calling for bubbles. Yeah.
Right. But it is strange that for as much as there is this talk of, I guess, bubble, it almost makes an extra amount of fear in there. And it seems like that level of fear is a little bit higher than you would expect for a market that is less than 1% off its highs. So,
Yeah, it's not just individuals, even institutional positioning is pretty muted right now based on Deutsche Bank and Goldman and all the stats where it's not stretched, it's not extreme.
mhm,
Usually sentiment moves with price. It's human nature. As we go higher, people usually become more bullish, and as we go lower, people usually become more bearish. As we've been going higher, it's a really weird thing with psychology where a lot of people are not getting more, they're not getting more bullish. I'm not saying they have to, but they're doing something different than the norm. They're becoming more scared, more bubble. Random friends that are casual market participants, they're like, when's the crash coming, when's the crash coming? I mean, it's just, I don't know if it's because there's too much social media, too many bloggers, too many financial networks, too much noise out there. Again, it's just like with the macro. I'm trying to shut all that out and keep it simple and just focus on what the market's doing.
yeah. And you know what? I got to be honest with you. In looking at the YouTube comments, it seems like more people, rather than focusing on what the chart is doing, more people are focused on what your tie is doing. There's a lot of people saying, well, gosh, it's purple. That's how we know that Joe is bullish. The fact that he's wearing a tie. There's a lot of sentiment factors out there on YouTube right now. Just
Yeah, no, you can read into whatever. Next time, if we're in a bear market and I got holes in my shirt and I haven't shaved and I look homeless, then that could be a low too. So yeah, you can interpret it whatever you want. My mom always taught me it's better to be overdressed than underdressed. So
yeah,
that's
okay.
I'm trying to stick with that.
um, so let's talk a little bit about some individual stocks, and probably worth starting with if you're going to talk AI, and you mentioned that certainly in 2023, that NVIDIA earnings report, where again it was already kind of a high level, and then the fact that they beat it by such a big margin, and it was
With
even
31 analysts following it and getting blown out of the water with their estimates.
right. And I mean, at that point too, it was like the PE, was going down because their earnings were just so incredible. But a lot of people pointing to what's been happening lately. It's and I'm not sure if you're aware of the bet between David Hatman Chung on IBD Live and David Ryan, the Nvidia versus AMD. David Ryan picked AMD to outperform Nvidia, and right now that looks like so far he's going to be enjoying a nice habit burger on David Chung's dime. But Nvidia, again, this has had such a move. Whether you look at the move that it had from 2023, which is off this chart, I have to do best fit just to see it, or even better if you go to the monthly chart. And sure, 2022 was no fun, but man, from 2016, at a split adjusted price of what is that, like 50 cents to
Less
200?
than a dollar. Yeah.
Yeah. So again, you'd be forgiven for kind of wondering and scratching your head. Well, how much more can you expect out of this? So what's your take here on Nvidia?
Well, one simple concept I've learned is moves in the market can go on much longer than we can expect. And I wrote about that in my blog post. In other words, just when you think something can't go higher, it usually does. And in bear markets, something's 20, 50% off of its lows. And you're like, oh, when it just, you think it can't go lower, like some of the gaming stocks during the
Mhm.
08, 09, they were 70% off their highs. They went 99% off of their highs. So just when you think something can't go lower, it usually
Mhm.
does. So moves get exaggerated. That's number one. Number two is Nvidia was 140 last June and it was 140 this June. So when you look at a weekly chart, it had been consolidating. It was 140 roughly last June, and it started to move out of this range as recently as early July of this year. So it has consolidated for a year. Yes, when you show that monthly chart, it's gone up, it looks like forever, but more recently, this whole thing, all Nvidia does is go up every day. For the past year, it didn't do anything. In
Mhm.
fact, it did have a couple of corrections. The third thing I was going to say is there is a concern that because of this huge capex spend, data centers, and we talked about, in the news, or the news has talked about Oracle and CoreWeave and some of these companies funding and maybe getting over levered into spending. The way I look at it is, if that becomes a problem with those companies, that could be a problem. It could also be fixed, but who's benefiting from all of this spend is Nvidia. So I still think there's more upside. I don't think the AI story is done. Uh, Jensen Huang just went to TSM, the Taiwan Semi CEO, literally came out this past Sunday night asking for more capacity, asking for more chips. I don't think he'd be doing that if the demand wasn't there. So I still think this AI story, people way smarter than me have also, and that's a large sample size of people way smarter than me, by the way. I think that people way smarter than me are still saying we're in the early innings of this and there's still more upside, but with bumps along the way. It's not going to be smooth. A perfect example is it just consolidated for a year.
Mhm. No, absolutely. And um, it, again, when you have a big leader, it's a good reminder, like what we said before, they don't go straight up, right? They do take those breaks. Even Cisco, with its 75,000% move in the 90s, it had well over a year where it was just sideways and like
Oh, and
95.
multiple 30 to
Yeah,
50% corrections,
yeah,
if
absolutely.
not bigger.
Yeah,
Yeah.
absolutely. Now, uh, I guess one of the things too here is, while the RSP, the equal weighted, might not have shown, great breadth, where the Russell 2000 might not be like, blowing the doors off of your expectations. There do seem to be like these other pockets, and sometimes it's AI related, right? It's, oh, it's not just the chips that are moving, but the utilities are moving because we need power and data centers and all of these things. Air conditioning is going, and all these kind of secondary AI adjacent moves. But there's also space. Space has been another area that has been very interesting. Here's Rocket Lab, and this actually, I had a really nice move in this last year. As it really kind of jumped. But you've got, whether it's the Golden Dome kind of idea of aerospace defense, or you've got the imagination running wild with going back to the moon, colonizing Mars, what have you. There does seem to be a little bit more excitement here. Now, Rocket Lab is just got turned away from its 50-day moving average line today, but what do you think? What do you think about this area in general?
Yeah, I still like space, and this is, talk about time frame. This is a 2027 and beyond, without the pun intended, space and beyond type of pun. But um, as we are moving forward with defense and with more satellites and all of that, I mean, with the way I look at it is, I put Rocket Lab on my blog publicly at $10 when it formed a high tide flag. So I'm in
Mhm.
it from a lower level. I've mentioned it to my educational members since, $4 or $5. I've traded around the position, but this is a longer term story. I know most people are like, give me something I can trade tomorrow that has options that expire in 7 seconds. But this is a longer term story. SpaceX's most recent funding round, they're still private, of course, but somewhere around, I think, 450 billion, maybe even close, call it 500 billion. And Rocket Lab, most of their rockets have been their Electron rocket, which is the smaller payloads into space. But their new Neutron rocket, which is supposed to launch in the first quarter of next year, is the closest competitor to SpaceX's Falcon 9 to carry some of the bigger payloads, as they're called, into space and so forth. Even not me, Barron's is called Rocket Lab, the closest competitor to SpaceX. So I still think that they both can do well, and with more contracts, I love their
Mm-hmm.
recent quarter. Profit margins are increasing per launch, and it bodes well. But again, it went from 10 to 30 something and pulled back to 15, and then it ran up. It's again, if you're holding something longer term, to what we've talked about and alluded to earlier, it's going to have multiple 20 to 50% corrections along the way if you're playing this for, let's say, the next few years.
Mm-hmm. And, as much as I know that you very humbly said that there's a large sample size of people smarter than you, it's kind of cool when you start talking rocket science. I mean, I feel like that just puts you in some upper echelon somewhere. Are you, because there's so many different players here, do you ever look at like an ETF like UFO or something like that? We've had Andrew Channon on before, but I mean, for a while there, it was like you had the drones and with AVAV and KTOS and
Yeah.
you've got the rocket labs and so on. Sometimes it's hard to know who the winner is going to be. Do you ever kind of
Oh,
consolidate them into an ETF or?
that goes. I like SHLD. There's a lot of them.
Hmm.
There's UFO, SHLD, Shield.
Yeah.
So you and XAR is another one
Hmm.
where you can. What I like about Shield is after the follow through day, when I screen, if you go to a daily chart, the follow through day in the Zweig breadth thrust was late April. It's really scary how I don't remember what I had for dinner last night, but I remember the most random dates in the markets. When I was screening, it was very, very strange to see an ETF at a new high. So after
Yeah.
that Zweig breadth thrust, it was at $50 at the end of April, and I was like, "Well, this is very interesting because usually you don't see an entire ETF at a new high, but this is not just the Rocket Labs and the SpaceXs that are benefiting. It's just overall spend on defense. Some of
Hmm.
these ETFs have your Lockheeds and Raytheons and some other components, and Boeing and some other components as well. So this is a way to participate, and just Google the components, whether it's UFO or XAR or SHLD. Just Google the components. Some of them are more space, some are more defense, some are a blend of the two, obviously with different weightings. But this is another great way to participate. To your point about drones, there's a bull market in drones going on as well with the Olympics and with the World Cup. I've been hearing a lot of people in the government talking about the increase, unfortunately, with security needed for a lot of things. There's a lot of there's a bull market and growth in a lot of things, aerospace, defense, drones related. And I love that you brought it up. A ETF is a great way to play it.
Hmm. And it's also, as you said, I think it's really important that you look at the holdings, look at the weightings, because sometimes when you get an ETF, you'll have like a large position in the ETF in Boeing, something that maybe you don't want as large of a position if it's not working out as well. So it's nice a lot of times that we have all these different options with our
Oh
ETFs.
yeah, I think
You know,
there's more of ETFs than people on
than
this earth, I
stocks.
think.
There are way more ETFs, I think, than stocks at this
Yeah.
point. It feels like, at least. And speaking of ETFs, we're going to go ahead and end on XBI. I do have a position in this myself. The biomed biotech area has just really seemed to kind of take off lately. And I mean, I'm going to go ahead and just say XLV too. The healthcare sector this week has just been phenomenal. And it's hard sometimes, I feel like, with the biomed and biotech stocks, because you have of like maybe 800 in our industry group, the biomed biotech industry group, maybe 10% or 20% are profitable,
Yeah.
probably 10% or less. Um, there's a whole host of them that don't even have revenue. It's like they are still at that point where they're one clinical trial away from bankruptcy. It feels like. So tell me a little bit about how you play the biomed biotech sector. And again, I know you said you don't chase rotations, but this does feel like there's a little bit of a rotation going on here with the medical stocks.
Yeah, I mean, XBI is more equal weight, so you get some of those small and mid cap names. I can't think of I mean, one of the benefits of an ETF is so you don't have to, let's say, choose, like we
Hmm.
said earlier, a specific stock if you're not sure which one to choose. But the other benefit is so you don't have to deal with single stock risk. I can't think of a better ETF because biotech is one of the greatest ones with single stock risk. So, XBI is equal weighted, IBB is more market cap weighted. Again, there's a website called Google where you can Google the components of them. But I don't
Yeah.
look at it as chasing sector rotation. To your point, with interest rates coming down, there's a couple of fundamental things going on here. With interest rates coming down, this thing is still off of its highs from late 2021. When you look at the weekly chart, with interest rates coming down, they're starting to come back up. The other fundamental thing is big pharma. When you take the top 10, roughly, your Pfizer's, your Merck's, your Glaxo's, some of the big pharma companies. Big pharma is going to generate over $1 trillion in free cash flow in the next 4 years. Merck alone is going to generate over 100 billion in free cash flow. So the whole point is you're going to start to see with patent expiration and with more drug discoveries and needing to fill their pipelines and so forth. You're going to see more M&A and just more of the small and mid caps benefiting. I feel like every other week there's a new buyout, and these buyouts aren't a billion or two like they used to be. Some of them are 5 to 10 billion and higher.
Yeah.
So I think it's just a sign of how robust some of those mega cap names are. Novartis, some of these Lillies, they're just such monsters, and they're always looking to build their pipeline and through acquisitions. So I think, again, longer term for people who have a time frame of more than 7 seconds, I think XBI is going to do well in the next couple of years.
Hmm. And it's funny because one of our long-term audience members, Tim, he was on IBD Live today. He's watching live right now, but he was on IBD Live today, and he actually was throwing some questions, preliminary questions for you. And one of them was kind of how do you toughen up traders to be a little bit more resilient and kind of take that long view as opposed to the impatience of, oh, it's it moved down today, and I want the things that are moving up every day. So
It's a great question. I think a lot of it has to do with improving your mental toughness in many different aspects of your life. And a lot of it can happen through gratitude, through working out, strong mind, strong body, and all that stuff. That'll help. But also, specifically for the market, is you got to do a little bit of work. There's a fine line between, conviction and stubbornness. I understand that. But, when they say losers average losers, tell that to Warren Buffett, who might buy something on the way down because he has conviction in something or might add to a position 20 or 50% down. So we live in such an impatient world and such a real-time world where something will have a normal pullback to support and people are like, what's going on here? And sometimes, at least for me, doing some fundamental work and understanding what these companies do so you don't buy it and you say, oh, I didn't know it was a semiconductor. I didn't know it was a medical products company. Like, it was just a chart with symbols and letters and it looked pretty. Like, doing some work, at least for me, I'm a nerd and I'm kind of a geek and I just like doing some fundamental work behind this. That helps toughen me up and gives me conviction. So when something pulls back, someone might say, well, I'm getting stopped out. I'm like, screw that. I'm buying more. As long as it's holding support within reason. I'm not being reckless. I'm not being complacent, but doing some actual fundamental work can really, really help with that.
yeah, and I think it's worth mentioning there too. You got to have rules that are guiding you. And like Warren Buffett, it's not like he's just buying something because it's down. There's plenty of things that are down that he doesn't buy. It's not
Correct.
that's not his point. His point is the value. He is kicking the tires on something. He knows the balance sheet and income statement backwards and forwards, and so he's seeing something. He's following his own set of rules. They might be different from ours, but it's amazing how a lot of sets of rules can still get a very great outcome, even though the rules are different.
Yeah, and I'm not encouraging anyone to be value or growth or time
Mm,
frame or anything. Just do something that works for you, works for your personality. If you don't have a personality, go out and get one, come back, rewatch this. I'm just saying everyone is different. There is no right or wrong way to trade.
mhm,
Do something that fits your style. And also, to your point about, within my rules, I think the best way to sum it up is it's conviction with flexibility.
mhm.
So that's why I said there's a fine line between conviction and stubbornness, where if I like something, I'll leave with the Druckenmiller line I use all the time is he says his greatest asset over the past 30 years is his ability to change his mind.
Yeah.
And David Tepper is super flexible. And William O'Neill would talk about being bullish one day and 2 days later, he worked closely with him, vice versa,
Mhm.
changing his mind. The greats always are flexible. So I will have conviction as long as the institutions are supporting it. If the story changes, then we can always change our mind.
No, absolutely. And speaking of having gratitude and everything, I'm real grateful that you are again out there giving the education that you do, Joe. I'm so happy when you come on the show because I think yeah, your mindset, your approach, your logic, and a dash of humor really helps out quite a bit. So thank you so much for being on the show again, Joe.
Thanks
Really
for having me,
appreciate it.
Justin. I always appreciate it. Thank you.
Okay, that's going to wrap it up for us this week. Thank you so much for watching. And hey, don't forget to check in with us next week. We're going to have Asbury Research, John Kosar, back on the show. So, of course, if you want to be interested in ETFs, he has all the sectors and a ton of ETFs that he does research on as part of his SEAF model. So, yeah, it'll be great to have John Kosar back on the show from Asbury Research. We hope you join us for that. And thanks for watching. We'll see you next time.